afternoon, Brian, and thank you very much for taking the time to join us this afternoon. I'm wondering if we could kick off briefly by finding out a little bit about you and your role within GQG Partners.
Absolutely. Thank you very much, and thanks for the opportunity to engage in this discussion today. Really looking forward to it. By way of introduction, I am Brian Kirschman. I'm one of the portfolio managers here at GQG, working alongside our CIO Rajiv Jain. Since day one, June 1st, 2016, when we first founded the business.
To start with, do you think you could summarise for us GQG's investment philosophy? What kind of characteristics are you looking for in the companies that you're considering investing in?
What we're trying to do and what we're trying to assess is this concept of quality. And now I know that that's not necessarily a novel concept. There are plenty of folks out there looking for high quality businesses at reasonable prices and things along those lines. But one of the things that we're trying to do specifically that's a little bit different is trying to assess this forward looking view on quality. Where is quality headed on a go forward basis? It means that we have to take a little bit more of a dynamic approach to quality and have an open mind about this is where quality is maybe not exhibited itself in a big way in the past, but we see that quality is emerging in those particular types of areas. And then there's other particular areas that have been high quality areas. Maybe that's deteriorating over time. So keeping an open mind that quality will ebb and flow into these certain areas, and being able to move in and out of those areas as we see quality exhibited or sort of deteriorating in those spots.
How would you say that this approach makes you different from and arguably better than other fund managers?
And this goes back to what I was speaking about sort of initially and saying that it's much more of a dynamic view of quality, and we allow ourselves to be a little bit more open-minded and nimble in that sense of where quality can be emerging. So you take the example of an energy company. And one of the examples I like to use here is Exxon. If you were to poll folks, call it 9, 12 months ago, is Exxon a high quality business? And say you polled a room full of 30 people and said, raise your hand if you think Exxon is, a high quality business. I bet one person out of that 30 people in that room would say that Exxon is a high quality compounding type of business. Well, if you think about this, in more of a historical context, go back 30 years. You poll 30 people in a room, 29 out of 30 people in that room would say it's a high quality business at that point in time. Now, it's the same business. You have a cyclical end market. You have a commodity that you're pulling out of the ground. By definition, it's the same thing that everybody else pulls out of the ground. But in one instance, one environment, you had a business where it was perennially compounding even through recessionary type cycles, and people are willing to own that as sort of a steady Eddie company. And then over the past several years, it's been in a very bad environment, swimming uphill, and it's been sort of lumped in with some lower quality assets. We think that the characteristics of this particular business are improving quite dramatically on a go-forward basis, and it can look like one of those very high-quality compounding business models on a go-forward basis from here on out.
And so how has that actually translated into performance then over the last, year or so and the year to date?
In terms of our strategies, we've been very beneficial in the fact that we have had a decent amount of energy exposure in general across our strategies. And it's been very beneficial in terms of being a store of value or a defensive characteristic of the portfolio, as these energy businesses have really held up, both through the performance of the business. The earnings have been some of the best earnings estimates upgrades have come from the energy space. And then also the dividend yields and sort of the dividend payments that we're getting off of these businesses as well have proven to be very resilient in the context of what's going on here. So if you actually look at our developed market strategies, most of them are about 1,000 basis points ahead of the benchmark, depending on which strategy you're talking about. Even our emerging market strategy as well is well ahead of its respective benchmark by a couple hundred basis points. So you can see that that exhibited, or that quality is being exhibited kind of in a different way, in a unique way. And what's interesting as well is some of the names that had been super high quality over the last cycle. We have had to de-emphasize those. We've actually reduced those within the portfolio because we saw some cracks forming within those businesses as well. The multiples continue to extend higher. And again, in a different environment, we saw that they were a little bit lower quality on a go-forward basis. And it made sense, from a risk management perspective, to reduce exposure on that side. So that had really helped us as well.
broadening out the discussion a little bit, um, GQG ignores traditional growth and value um, perspectives when it's investing. So, to what extent, if at all, did this year's rotation into previously less fashionable parts of the market actually affect the portfolio's performance? If you could say a little bit more about the moving, the standing back from growth and value.
And this is a question we get a lot because a lot of folks want to put folks into a box, or a manager in a box, and say, are you a growth manager? Are you a value manager? And one of the things that we always say is that there's great growth companies, there's great value companies, and then there's just great compounding businesses. And that's really what we're trying to find, is great compounding business. So you can have a business that trades at a high valuation, but if there's the headroom to continue to support that high valuation, that high multiple, if you will, and a really strong growth rate that goes along with it, then we're willing to own names on that end of the spectrum. And then on the other end of the spectrum, if you have a name that is incredibly cheap, but it's exhibiting this forward quality that we're talking about, and you can get to a very sort of a high degree of confidence in the earnings trajectory of that business on an ongoing basis, we're more than happy to own things on that end of the spectrum as well, especially if we believe that quality is being exhibited or enhanced in that particular area on a go-forward basis. So if I take it back to sort of the context of the rotation that we've seen in our portfolio over the past, call it 12, 18 months, one of the things that we have noticed, and we did notice sort of pre-COVID, for example, is that you're in an environment where growth was very constrained. Global growth was fairly slow. You have very easy monetary policy. So what made sense when growth was constrained was to pay a little bit more for that growth. So find the areas that are growing and be willing to pay a little bit more for those areas that are growing, and that would benefited you very well in a sort of global financial crisis all the way through 2020. What happened during COVID is when things got locked down, growth was actually tightened down or constrained even further. And to the extent that some of our peers actually went a little bit further than we did in this sense, but to the extent that you absolutely plugged your nose and bought the best top line growth story, revenue growth, the fastest revenue growth overall, that worked really well for you over that sort of 2020, even 2021 time period. But what we began to see from a GQG perspective is that growth started to proliferate. We started to see that commodities, globally, we're starting to really see strong pricing and see strong demand and volumes picking up. We started seeing the underlying businesses really starting to accelerate, even in areas where there wasn't a whole lot of stimulus that was given to sort of the population, like in the emerging markets, for example, where stimulus wasn't as commonplace as what we saw in the United States or in Europe. We started seeing growth really start to spread out. And the reason I bring this up, if growth is starting to spread out to more of these areas, then it becomes more ubiquitous. And if growth is becoming more ubiquitous, then it makes more sense to pay attention to the price that you're paying for that growth. And if you're finding some of these quality areas emerging in areas that you haven't seen in a while, it makes more sense to be valuation sensitive, but you can find these high quality entities or these businesses in areas that you haven't seen them in a long time.
I know that ESG, environmental social governance issues, are very much of a buzzword these days, but how important are they when you're selecting stocks? How important is ESG in your stock picking?
ESG is actually incredibly important to our individual sort of our philosophy and our process in terms of the way that we pick stocks, because as I mentioned before, we're very focused on this concept of forward quality and taking this longer term view. And if I'm not taking these risk factors into consideration, or these opportunities, by the way, if I'm not taking these into consideration on a longer term basis, there's a material financial headwind or tailwind that I'm missing in some of these cases on a longer term basis for these types of investments. I think the real key difference is, in terms of the way that we would look at ESG and the way that a lot of other folks are looking at ESG or have looked at ESG up until this point, is we're taking a much more nuanced view. So if I take energy, for example, Obviously, it's hard to sort of mix the two. We have a large exposure to energy. We just talked about all those different types of things, and energy has been sort of synonymous with how can you possibly be okay with that from the E perspective in ESG. Well, it's about the materiality of the risk. And what does that mean? Well, how severe is that risk, and how much is that risk going to financially impact the business on a go forward basis, and how much does that impact the thesis, and how much am I already paying for that risk for the multiple or the valuation that I'm paying for that business today? So if I take an energy business and I look at them and I say, okay, well, if energy is going to be demanded for a lot longer because the transition is going to take longer than I think it's going to take, then the risk of stranded assets dramatically reduces versus what people are expecting them to be at this point in time. And if I think the supply is going to be constrained, that's also an issue that, again, the materiality of that risk is going down. They're also cleaning up their act from a carbon exposure. They're reducing that. Even if I mentioned Exxon earlier, Exxon may not be going out and building offshore wind turbines or onshore wind turbines, but they're actually leveraging their assets and doing things like carbon capture and sequestration using the existing pipeline infrastructure and sort of the physical assets that they have today. So they're optimizing that and they're driving down carbon exposure. We see that as being sort of the more of the essence of what you're trying to do from an ESG standpoint, and that you're trying to drive a cleaner world and transition so that we can make this progress in a very constructive way, not simply saying we don't need these things.
How important then is the potential to influence corporate behaviour through active engagement?
We engage our companies and we make it known in sort of what we believe is the appropriate way for these folks to manage these ESG risks, to manage the materiality of these risks on an ongoing basis. And we've had constructive conversations with a number of management teams about these topics. From a shareholder perspective, we're not activists by any means, so we're not trying to take board seats and influence strategy in that way. But we are also, communicating with them what we believe is the most financially responsible way to run the business in our eyes, just like we would with any other strategy. You can talk about that with pricing and things along those lines, and sort of how you defend your moat with your business. We want to do this with some of these ESG topics as well, to the extent that is creating material risks to the business. So we do engage with these folks. We do talk with these folks, and we do make our sort of our viewpoints known.
On an individual stock level, are there certain sectors, well, you've talked actually about a number of sectors where you're finding particularly plentiful opportunities. I just wondered if there were any other specific examples of interesting stocks that you'd like to flag up for us.
I'll stick with the energy theme because I think this is really interesting, and I think there's a lot of things that people have misconceptions about the space, that a lot of these businesses can't be compounders. But if you look at a name like a Petrobras, Petrobras is a Brazilian national oil company. So the Brazilian government has a majority stake within that business. And again, this is an assessment of forward quality that we've made. We've deployed our non-traditional analysts to look and make sure that there has been a culture of change within that organization since the prior sort of incidents and issues that have happened within Petrobras in the past. We have engaged with the management team and talked about, okay, these are the types of things that we think are material in terms of risks and opportunities on a go-forward basis. And we've taken a number of different views from a traditional side as well in terms of how we believe this company will continue to proceed. But the interesting thing about Petrobras, what makes it really unique is, they had gone through a process of taking leverage out of the business, so reducing their debt exposure to a point where they crossed, call it a $60 billion debt threshold. And once they got through that threshold, they were able to start paying back the majority of their excess cash back to shareholders. And this is where it gets interesting from an investment standpoint, because Petrobras now makes more money, even if oil is at $70 a barrel. Petrobras makes more money at $70 a barrel than they used to make in excess of $100 a barrel during the last cycle. So they become dramatically more profitable and cash generative during this cycle. And what does that translate out to? Well, if you look at Q1, we got high single-digit dividend yield in the quarter, so call it 8% dividend yield for the quarter in quarter number one this year, based off of Q4 oil pricing, called $70 to $80 a barrel at that point in time. Fast forward Q2, when they announced the dividends and announced everything, and they paid out their dividends, and it was based on, call it maybe $80 to $90 a barrel that we saw during Q1. Again, this is pre the Russian invasion. So during Q2, we picked up low double-digit dividend yield, call it 11% dividend yield for the quarter in that particular quarter. In Q3, after oil prices really started to escalate and we got maybe up to $120 a barrel globally, for the quarter, what we're getting in terms of the dividend yield, they've announced it recently for the quarter, we're going to get 21%, called low 20s, 21% dividend yield for the quarter. So I almost don't even care what the stock price is doing. I've picked up, call it an 8, an 11, and a 21% dividend yield in three successive quarters this year. And again, even if oil stays in, call it the $70 to $80 a barrel range, I'm picking up almost 40% in return just off of the yield alone.
Are there any bad calls that you would like to tell us about, recent ones?
There's always plenty of bad calls. One of the things we always joke about is like there's always plenty of places that we could nitpick and find opportunities that we could have done better. And one of the things that I think we'll talk about, and it's an interesting illustration too of how we think about risk management, but it is ultimately something we wish we would have done better, with hindsight being 2020, is the Russia situation. So if you look at our emerging market strategy, for example, we had 16% exposure in Russia in December of 2021, coming into January of 2022. So very heavy exposure. Our international strategy, ex-US, had about 6% exposure in Russia, and our global, I want to say, had about 3% in Russia. So materially less in global, but still a pretty substantial size. This goes to kind of the risk management process. So we are a fundamental bottom-up driven process, but we will use macro as a switch off in certain instances. And when it came to the Russian situation, we did start to see that there were troops building up on the border between Russia and Ukraine. And although it was a very small probability, the probability was increasing that a very massive tail risk event could happen. Now, our assessment at the time was that there really wasn't reason for Russia to invade Ukraine. We didn't see sort of a tactical advantage. You would be occupying enemy territory. The Ukrainians, we thought, would fight very hard for their freedom, as we're seeing at this point right now. But ultimately, there was an increasing probability. So what was interesting is we started dramatically reducing a lot of our Russian exposure even earlier in January, despite the fact that the fundamentals, if you're looking at the bottom-up situation, especially the oil and the commodity businesses, they've gotten dramatically better. So we had sold that off. Now, hindsight being 2020, we could have acted even faster than we did. It was our opinion that even if some of these energy and commodity businesses were sanctioned, that we would have time to continue to escape those types of businesses and sell them down. We see that in other situations, by the way, where companies have been sanctioned, they still trade almost $200 million a day. So you have time to wind them down. What we did not anticipate is that by the U.S. enacting a freeze on the U.S. Treasury assets within the Russian central bank, that would trigger capital controls that would freeze us. Now, we had done a lot to reduce the damage, potential damage that could come from that. So called low single-digit exposure within the emerging market portfolio, from 16% exposure down to low single-digit exposure, so dramatically reduced our sizing there before those capital controls came into place, and less than 1%, so I'll call it 60 basis points, 0.6%. Within sort of the global and the international type strategies as well, in terms of aggregate exposure. So we reduced it dramatically, but hindsight 2020, we could have gotten out a lot faster. So I would say that was a learning for us, that now these capital controls are in play, and that the U.S. is willing to sort of freeze those assets overseas, and the repercussions on the other side.
Well, thank you so much, Brian, for taking the time to speak to us today. It's been very interesting and a revelation. And all the best. Thank you very much.
No, thank you very much for the time. Really enjoyed the conversation, and I look forward to speaking again soon. Thank you.